Hey YouTube, it's Matthew Decker, Leveraged Wealth Management. Today we are going to be talking about premium finance life insurance in this episode of Takedown Thursday. Now when it comes to premium finance life insurance, this is a sales concept, or rather a strategy involving cash value life insurance where you borrow money from a bank. And that bank then pays the premiums for your life insurance policy. Your life insurance policy is held as collateral, and you basically get to live on the arbitrage between what the bank is charging you and what your policy is earning. Now, for the right people, premium finance life insurance can be a phenomenal long-term strategy for wealth accumulation, paying for estate taxes, and there's a few other uses for it as well. And I've done several videos on premium finance life insurance, so I will link those in the description below in case you want more information on the risks associated with premium finance, or who's a fit for it, who's not a fit for it. We also have a whole page on our website dedicated towards premium finance life insurance. But the reason that I'm shooting this video today is because when interest rates go low, and right now they're rock bottom, all of a sudden everybody becomes a premium finance expert. And I start seeing more and more and more of these premium finance designs. And I think the reason that I start seeing so many more premium finance designs when interest rates are low is because literally anyone that has access to illustration software can make a premium finance policy work, because you don't have to earn that much in your life insurance policy if you're using a less than 3% loan rate from a bank. Your numbers are almost always going to work out. And all of a sudden, you don't actually have to design the policy the right way for the premium finance strategy to work on paper. The problem is these things rarely work the way that they're supposed to work on paper when we use projections that are extra rosy. And so I'm going to share my screen and we're going to go through a specific example of something that I see quite often as it relates to premium finance life insurance. And we're really just going to take one issue with this particular policy here, only because I don't want to spend tons and tons of time kind of detailing all the things that are wrong with premium finance in today's day and age. I just want to pick one thing. So before we get into what's wrong with this design, I just want to really quickly highlight what's going on. So you've got 12 columns across the top here that you can see that detail a bunch of different things. What's the IRR? What's the cash value, surrender value? What's the premiums being paid? And I really want to focus in on just a couple columns. So the first column I want to focus in on is column 1. These are the actual premiums that are being paid into the life insurance policy by the bank. Okay, so that's column 1. The other column I want to focus on is column 4. Column 4 is the out-of-pocket expense that this client is paying on a yearly basis. Okay, so the out-of-pocket expense for the client. And then we've got column 9, which is the collateral that's going to be required in order for this transaction to work. In order for the bank to lend this money, they're going to have to hold a high watermark of collateral, probably in this 238 to 254 range, in order to make this transaction whole and work. Okay, so we've got column 1, premiums paid by the bank into the life insurance policy. Column 4, premiums paid out of pocket by the client. Column 9, collateral estimate. Now, the way that I know that this policy is designed wrong, without even spending hardly any time at all looking at this, is I'm looking at column 6, column 7, and column 8. So these 3 columns right here, we've got our loan balance, we've got our illustrated policy value, and we have our cash surrender value. Now, traditionally, premium finance policies, you have to basically pull out all of the tricks in order to design these the right way so that you can outperform your loan rate, okay? And so one of the things that nearly every good premium finance policy has in common is they are going to use term insurance. A lot of times these are shorter pay schedules, and when you have a shorter pay schedule, you can blend in term insurance, then peel the term insurance off as soon as you're done paying premiums. And that creates a little bit cheaper policy. Now, if you're paying forever, it's harder to do that. But in these types of policies, you can typically get away with that. And so I know, looking at this right out of the gate, there's no term blending on this policy. And the way that I know that is by comparing our illustrated policy value, $138,000. So we've paid in $170, we have $138 in accumulation value, that's the amount of money earning interest, but we only have $13,000 in cash surrender value. And since we only have $13,000 in cash surrender value, it requires $157,000 of cash as collateral held by a bank in order to facilitate this transaction. And so what I'm going to do to fix this particular projection is I'm simply going to rerun all these numbers and I'm going to blend in some term insurance. And you're going to see two things that happen right out of the gate. Number one, the required collateral is going to go down. The reason the required collateral is going to go down is because you're going to have a higher cash surrender value in that first year. Number two, the income that's being projected. So on this policy, it's showing $310,000 a year in year 26. The income projection is going to go up because I'm going to make the policy cheaper by blending in term insurance. Those are the only two things that we're going to look at, and they're going to be changed by simply doing one thing, which is blending term insurance into this contract. And again, the reason that no term is being used is because with interest rates in the toilet, anybody can be a premium finance guru, but few often are. So let's look at how we actually fixed this policy, and we will just go from there. So this is the policy that we reran. We used all the same projections. So they were doing a 0% return in the first 2 years, 6% after that, $170,000 a year for the same 10 years. We have the same loan payoff in the 16th year. Everything's identical. We have the same basic death benefit, but the one thing that we did differently is we blended in term insurance. And by blending in the term insurance, we took a lot of the commission out of this contract. We reduced the fees, and we gave you higher year one cash surrender values. Look at that. $80,000 cash surrender value in year one, $145,000 accumulation value. So right out of the gate, doing nothing other than blending in term insurance, we've offset your required collateral by about $70,000. Okay, we've offset the required collateral by about $70,000 in year one. Cash surrender value in year two is $152 on this bad premium finance design. We're at $224. Again, we're offsetting collateral by about $70,000. So right out of the gate, that makes this a much more viable transaction because the liquidity required to make this contract work is less on the client on your part. You don't have to stake as much cash with the bank in order to make this transaction work. So that's the first thing. The second thing is it reduces the fees long term. And so when we go to actually take income on this policy in the same 26th year, we're up to $343,000 a year. In the old design with no term insurance and maximum commission, we're at $310,000. So we're talking about $30,000 of income every single year that you start taking money out of this starting in year 26 for life. If you've got a 30-year retirement, you're talking about $30,000 a year times 30 years. That's a whole heck of a lot of money. And the only reason it's more is because we decided to make the policy cheaper by blending in term insurance for a short amount of time, then peeling the term insurance off when we're done paying premium. So I don't want to spend too much more time on this particular design simply because there's a lot that we could talk about, but that's by far the biggest thing that I see. And I'm just going to reiterate the problem. When interest rates are low, everybody wants to sell premium finance. And the reason they want to sell premium finance is because they can get away with financing huge policies without having to reduce any of the commission on the contracts. And that's the wrong way to do it. And the reason it's the wrong way to do it is because it increases the likelihood that the policy doesn't work the way it's supposed to do. There's more that's wrong with this design. For example, I'd love to see more skin in the game in terms of an out-of-pocket payment. I think that we were showing, $5,000 a year out of pocket. In a typical premium finance design, that's just not enough skin in the game to really make this thing work long term. But that's the smaller issue. The bigger issue is premium finance. So here's what I'm going to tell you. If you've been proposed a premium finance policy, or if you're considering a premium finance policy, I urge you to get a second opinion on it. And the reason I urge you to get a second opinion on it because it's very easy to spot policies designed the wrong way. And when you do it the right way, it's an instantaneous, immediate positive benefit for you, the client. And so if you're looking at one of these and you need some help, please reach out to us. You can go to our website. We've got a whole page dedicated to premium finance. I'll link that in the comments below. You can go to our contact us page and fill out a form and we'll reach out to you and help walk you through this complicated transaction. One thing about premium finance, it can be one of the best things that you do if you're the right client for premium finance. You have a high net worth, you have a liquid net worth, you're comfortable with leverage. If you fit that criteria, this could be a really good strategy for you. But if these policies are designed the wrong way, and 5, 10, 15 years down the road, they implode on themselves because it wasn't done right at the beginning, this can be one of the worst things that you own. So you gotta make sure that with these policies in particular, especially because you're entering in a bank who's gonna have their own requirements from a collateral standpoint, from a liquidity standpoint, you gotta make sure premium finance policies are designed right at the beginning. I'm going to be talking a little bit more about premium finance as the weeks go on and showing you some additional examples of policies done right versus policies done wrong. But again, if you're considering one of these, please reach out to us. Let us help you. This is something that you absolutely want to get right, and we are here to help. This has been Matthew Decker with Leverage Wealth Management. Please subscribe to our channel, click the bell for notifications, and let us know in the comments what you want to focus on in future videos. Until then, take care.